The second paycheck had already been direct deposited for nearly 8 years before they realized it no longer felt optional. By the time the promotion stabilized and the childcare years began to taper, their household income looked solid on paper. Two mid career professionals in their early 40s, health insurance through one employer, a 30-year fixed mortgage at a rate that once seemed fortunate. Retirement contributions consistently deducted before either of them saw the money. It had the structure of responsibility. The second income began as a reinforcement. In the early years of the mortgage, it functioned as margin. It allowed for quicker student loan repayment. It made daycare possible without dipping into savings. It absorbed the unpredictable repairs that came with an older suburban home. Roof patches, HVAC replacements, plumbing that failed at inconvenient times. They described it casually to friends as helpful. Over time, helpful shifted into foundational. Raises arrived slowly but predictably. Property taxes increased more quickly. Health insurance premiums climbed in uneven increments. Childcare costs peaked and then gave way to after school programs, summer camps, youth sports fees, travel for tournaments. The expenses changed shape but did not meaningfully shrink. In year 9 of homeownership, they refinanced to capture a lower rate. The monthly payment dropped by several $100s. It felt like breathing room. They redirected some of the savings into retirement accounts. The rest quietly absorbed lifestyle drift. Newer vehicles financed over longer terms, a kitchen remodel financed through a home equity line, upgraded insurance coverage. None of it appeared excessive in isolation. Each decision had a rationale. At tax time, their accountant once commented that they were doing well. Their combined income placed them comfortably within the middle to upper middle segment of their metro area. They were not high earners by coastal standards, but in their region, they were stable. They carried no revolving credit card debt. Their credit scores were strong. They funded 529 plans. They increased 401k contributions incrementally. The system worked because both paychecks arrived twice a month. When one employer went through a restructuring in their early 40s, it introduced the first quiet tremor. It did not result in a layoff. It resulted in role consolidation, longer hours, fewer internal mobility options, a salary freeze masked by a one-time retention bonus. The second income remained intact, but its stability no longer felt abstract. They reviewed their monthly outflows for the first time in years. Mortgage, property taxes, homeowners insurance, two-car payments, auto insurance for a newly licensed teenager, health insurance premiums deducted pre-tax, utilities that had climbed steadily, streaming services, cell phone plans, student loan payments that lingered longer than expected due to earlier income-based repayment structures, contributions to retirement and college savings. The line items formed a structure that assumed dual participation. If one income disappeared, the mortgage could still be paid, but retirement contributions would pause. College savings would slow. Discretionary spending would contract sharply. Emergency savings would erode if unemployment extended beyond several months. The math did not suggest collapse. It suggested compression. The compression would not be temporary unless employment resumed quickly. The realization did not arrive in a dramatic moment. It surfaced during an ordinary Sunday afternoon while categorizing transactions in a budgeting app they had neglected for years. The numbers were not alarming. They were simply interconnected. Their home had appreciated since purchase. Equity existed. But selling would mean re-entering a higher interest rate environment. Downsizing locally would not reduce property taxes meaningfully because assessments had climbed across the district. Moving farther out would lengthen commutes and increase transportation costs. The housing market had shifted while they were busy stabilizing careers. The second income was no longer an accelerator, it was load bearing. During their 30s, they had framed dual employment as optional empowerment: 2 degrees, 2 career tracks, 2 retirement accounts. It felt progressive and prudent. Friends did the same. In their social circle, single income households were rare and typically linked to either very high earners or deliberate lifestyle trade offs that required geographic flexibility. Their version did not include geographic flexibility. Both careers were anchored to their metropolitan area. Their mortgage anchored them further. As their children approached high school, extracurricular expenses intensified. Travel teams required flights and hotel stays. Academic tutoring filled evenings. College admissions consulting appeared quietly in conversations among neighbors. None of these costs were mandatory, yet declining them carried social friction. The second income buffered those choices. They never labeled the arrangement as permanent. They simply renewed it annually by continuing to show up to work. In year 15 of marriage, burnout became less episodic and more structural. Vacation days were used to manage logistics rather than rest. Sick days were coordinated carefully to avoid simultaneous absence from both workplaces. The household calendar resembled a project management board. They considered what would happen if one of them stepped back professionally, not stopped working entirely, but reduced hours or shifted into a lower stress role. The gross income impact appeared manageable in theory. The net impact, after taxes and benefits, was narrower than expected. Employer sponsored health insurance attached to one job limited flexibility. Changing coverage to a marketplace plan would increase premiums and deductibles. Retirement contributions would shrink. Employer matches would decline. The financial architecture had quietly intertwined with employment structures. In conversations with older colleagues approaching retirement, they heard similar refrains. Dual incomes had enabled college funding and mortgage payoff, but many described working longer than originally imagined, not because of debt, but because of maintaining healthcare coverage and preserving retirement balances. The two income pattern extended further into life than anticipated. Their retirement projections, when reviewed in financial planning software, assumed continued contributions at current levels until at least age 65. Reducing one income in their mid 40s would shift the curve. It would not eliminate retirement security, but it would delay certain benchmarks. The software recalculated automatically, dispassionately. The second income had gradually transitioned from a strategic advantage into a requirement embedded within long-term projections. They had not overspent recklessly. They had purchased a home aligned with their combined salaries at the time. They had chosen vehicles consistent with peers. They had avoided luxury vacations. Their decisions aligned with conventional middle-class prudence. Yet, the structure itself depended on two participants indefinitely. During performance review season 1 year, one of them received feedback suggesting limited upward mobility without relocation. Relocation was implausible. Their children were settled. Their mortgage rate was historically low. Their extended family lived nearby. Selling the home would mean surrendering both interest rate and community. The career ceiling became a fixed point. Meanwhile, inflation reshaped baseline expenses. Groceries increased. Home insurance premiums adjusted upward after regional weather events. Utility costs fluctuated. None of the increases were catastrophic. Together, they absorbed incremental wage growth. The household budget resembled a stabilized ecosystem. Removing one major input would shift the balance. They occasionally imagined an alternative version of their 20s, where they purchased a smaller home or remained renters longer. But those decisions were made within a different interest rate environment, a different housing market, and different career trajectories. Revision was theoretical. In their mid 40s, health became part of the equation. Routine medical appointments multiplied. One minor surgery required several weeks of recovery. Short term disability covered a portion of income, but not all. The payroll deposits dipped. The mortgage auto payment continued unchanged. The gap was manageable because both incomes did not disappear simultaneously. The scenario illuminated the structure further. Their emergency fund covered 6 months of essential expenses if both incomes ceased. But the definition of essential required stripping retirement contributions and discretionary spending to the minimum. It assumed swift reemployment in a competitive labor market shaped by automation and periodic layoffs. They observed France navigate similar transitions. One household shifted from dual income to single income after a layoff, intending it to be temporary. 2 years later, the second partner had not returned to comparable compensation. Retirement contributions lagged. College savings slowed. Lifestyle adjustments persisted quietly. The pattern was not dramatic enough to generate headlines. It was incremental. As their parents aged, additional financial responsibilities surfaced. Travel for caregiving, occasional financial assistance, legal consultations regarding estate planning. These were manageable within dual income. Within single income, they would compress other priorities. The realization that their lifestyle, while modest by some standards, was calibrated to two salaries did not induce panic. It induced clarity. They were not trapped in debt. They were anchored by commitments made responsibly over decades. The mortgage amortization schedule showed steady principal reduction. Retirement accounts grew with market fluctuations. College savings accumulated gradually. The numbers indicated progress. Yet, the progress was conditional. At a neighborhood gathering one evening, conversation drifted toward early retirement fantasies. The numbers cited were aspirational and detached from local property taxes, healthcare costs, and college tuition inflation. It sounded appealing in abstraction. Within their spreadsheet, it felt distant. They did not resent the second income. It had funded stability. It had prevented financial fragility during economic downturns. It had diversified employment risk across two industries. It had allowed them to weather recessions without liquidating retirement assets. It had also normalized a level of fixed obligation that no longer flexed easily. In quieter moments, they noticed the absence of slack time. Weekdays were structured around work schedules. Evenings revolved around logistics. Weekends filled with deferred tasks. The household operated efficiently. Efficiency was not the same as ease. When annual benefits enrollment arrived each fall, they evaluated health plan tiers, flexible spending accounts, and retirement contribution percentages. The forms assumed continuity. They selected options that optimized for dual employment because that was the current reality. The second income was integrated into tax withholding calculations, social security contributions, and Medicare projections decades into the future. It shaped eligibility thresholds for certain tax credits. It influenced marginal tax brackets. It determined how much they could contribute to Roth versus traditional accounts. It had become part of their financial identity. Occasionally, they ran informal scenarios. What if one of them transitioned to part-time consulting? What if they accepted a lower paying but less demanding role? The gross salary reduction looked modest. The net cash flow shift was sharper after accounting for benefits, taxes, and retirement matches. The spreadsheet absorbed the numbers without judgment. They closed the laptop without making changes. The second income had begun as a choice. It had evolved into infrastructure. As their children approached graduation, college acceptance letters arrived alongside financial aid packages. The 529 balances covered a portion, not all. Cash flow from current earnings would bridge the remainder. Student loans for their children were discussed cautiously. The dual income provided optionality. They signed tuition payment plans linked to checking accounts funded by both employers. On paper, their net worth increased annually. Home equity rose. Investment accounts appreciated over long horizons. They met benchmarks commonly cited in personal finance articles. The metrics suggested progress toward security. The lived experience felt narrower. They were not unusual. Census data showed rising prevalence of dual income households among middle income Americans over the past several decades. Housing costs relative to income had shifted. Healthcare expenditures had grown. College tuition had escalated beyond wage growth in many sectors. The macroeconomic backdrop formed the context of their micro decisions. Their household became an example of adaptation. In their late 40s, one of them received an offer from a smaller firm with slightly lower pay but more predictable hours. Accepting it would reduce annual household income by a measurable amount. The mortgage would remain affordable. Retirement contributions would need adjustment. College funding for the youngest child would require closer monitoring. The long-term retirement age might extend by a year or two. The offer sat open in an email inbox for several days. They reviewed their amortization schedule again. 15 years remained on the mortgage. At their current payment pace, it would be paid off shortly before their early 60s. Accelerating payments was possible, but it would tighten monthly cash flow further. The second income allowed them to consider optional prepayments. Without it, prepayments would pause. The offer was declined. Stability won over recalibration. Life continued in its structured rhythm. Direct deposits arrived on alternating Fridays. Automatic transfers moved funds into retirement and college accounts. Bills were paid without incident. The household maintained its outward composure. The realization remained present but unspoken. Two incomes were not merely advantageous. They were the structural assumption upon which the last 20 years had been built. There was no singular decision that created this outcome. It formed through incremental commitments, each reasonable, each defensible, each aligned with prevailing norms for responsible adults in their region and income bracket. The second paycheck continued to arrive, steady and unremarkable, carrying with it the weight of mortgages, tuition installments, insurance premiums, property taxes, retirement projections, and the quiet expectation that both adults would remain economically active at full capacity for decades. Nothing about their situation appeared unstable. Nothing suggested imminent crisis. Yet the margin that once felt expansive had narrowed into precision. And the architecture of their financial life stood balanced on two foundations that had long ago stopped feeling interchangeable.